last video what an order block is, what an order block isn't. In this video, I'm going to go a little bit more in detail and explain to you how you can actually use order blocks to enter and exit trades. Okay, now from an institutional perspective, an institutional standpoint, the order blocks reveal the big banks or the institutions' overall order flow. Okay, and I can say on the higher time frames, you're going to find order blocks on the daily chart, 4 hour, all the way down to the 1 minute, 30-second chart if you're going that low. And not all order blocks are created equal. So this video is to kind of explain to you what's the more high probability you're going to get with specific order blocks, so that you can see the differences. Okay, and so right here, what you can see is, first things first. So right here, the first thing that needs to happen is you need to see a break in market structure. Okay, and when you see a break in market structure, then that's when you know that that order block is a strong potential order block. And then you need to see, part two is you need to see a huge expansion from that break in market structure. And part three is you need to see a return back to that origin of where that order block happened. Okay, to see where you're going to enter at. So let's show you here. So here you have, okay, so you have like a bullish order flow right here, right? We got price pretty much going up and down, up and down. We have a bearish order flow here. So what happens is we see a drop, and then what happens? We see a break. We see the sell side liquidity, right? So we see the sell side liquidity. It gets broken, and we see the last down candle, and we see an explosive move up, right? We see an explosive move up. So now we know that the market makers, they took the sell side liquidity, okay? They drove the market back up. So now we're waiting for a return to origin, or return to the order block. Okay, and I typically I usually take the entries depending on how it looks on order blocks where there's not like a really strong wick. I'll take it at the body, but if I see a pretty long wick, I would usually take it. My point of interest would be at that wick. So we see this order block, okay, and so right here it is. So what we have is, so we have a break, then we have another break in market structure. Okay, so we have the shift in market structure. So let's go back. So we had bullish order flow. Okay, we had bullish order flow. We had a high. We had sell side liquidity here. Okay, price drove down and purged all this sell side liquidity. Okay, and it had that last down candle, and then price goes up untested, and we have a shift in market structure. Okay, we have a temporary shift in market structure here when we go down to get this sell side liquidity. But once we see the move up, we know that they still want to continue on this bullish run, right? Because you can see that shift in market structure here. You see that it breaks that previous high. So we have a shift in market structure. So we get this shift in market structure. So now my eyes immediately goes back here, okay, in this area, because I'm looking for that return to this order block. And so as soon as price comes here, what do we see? We see a rally back up. So now we're looking here at ideally based off of what your model is and everything like that. Obviously this is going to be perfect because this is in hindsight, but typically I also measure out, you want to measure out the mean threshold of an order block. So pretty much like a timing purposes, I'm trying to keep this video as short as possible to get straight to the point. But typically my stop loss is maybe like 5 to 10 pips below that mean threshold. And so here you got a 1 to 6 risk to reward ratio. If now, depending on like if you're a short-term trader, we are on the 4-hour chart. So this is over a course of pretty much like a day or so. So if you're a short-term trader, obviously you can go down to the lower time frames. If you're a scalper, for me personally, like my weekly goal is 50 to 100 pips. So just hypothetically speaking, if this was for me, if I'm looking, to capture my 100 pips, this would be a 1 to 5, and I would be perfectly fine. So I would be in this trade for what? 4, 8, 12, 16. Let's see. If I got into this trade, I got triggered right here. Didn't have much drawdown. So a day. So I'll be in this trade for a day, pretty much. And so that's essentially, this is a high probability order block. Okay, this is a high probability order block, and I'll put the steps down there below. But this is a simple return to origin. So 3 things have to happen. You have to have a particular order flow, right? You have to have a break in market structure, which, so you have this break in market structure. Here, that's happened right here. You have a break in this market structure. You have that last down candle, and then you have a strong surge up to have a shift in market structure, right? So now you see this high breaks that previous high. So now I know that they still want to continue up. They still want to climb up and capture some more sell side liquidity. My eyes go here to this order block, and I'm waiting patiently. You're waiting here 3 days for this to happen. So this is where, this is a topic of a different conversation. Patience pays in this market and in this game. But so that's one example. Okay, let's try to find another example. Let's see how much more time we have here. So okay, boom. Okay, so now price does its thing. It comes up, right? And we see another order. I see an order block. I just see them fairly easy. Okay, so you have this order block. So now you get a shift in market structure. Okay, I see a shift in market structure here. Right, I see that shift in market structure here. But I see that break in market structure. I see that this break, it broke this structure. It created the sell side liquidity, right? Created the sell side liquidity here. My eyes went here to this order block. My eyes goes to this order block because we have this break, right? We have that break in market structure. Okay, now granted, they don't have to happen like how I explained it on the last one. Like the break in market structure has to come first. This one I saw a shift in market structure first. Then I saw that break in market structure. So my eyes come back here. So if I know if I see that price, didn't break this structure, I saw price rally back up, my eyes immediately go back here to this order block. It goes back to this order block. Return to origin. So price returns to that origin, and I'm taking the entry here. As soon as price returns, I'm putting my stop loss. Your stop loss is always safe above the order block, as in as a whole, that's a safe stop loss. I mean, some you can put it at the midpoint or that median threshold of the order block, which is, I got this magnet. So you got the median threshold like right here, okay? So you got this median threshold, okay? So, as far as stop loss placement, you can put it a little bit above, because typically if it goes above that median threshold, then it's probably not going to be a valid order block. And you'll know pretty immediately, because you want to see an instant price reaction, okay? So you can have a tight stop loss, but if you want to let the trade breathe, then you can put it in the most logical position, which is above this previous high within the order block. So in this case, a 20 pip, we're on a 4-hour time frame as well, so like my stop losses would be a little bit more, I would give it a little bit more cushion. Okay, so say that your goal is 50 pips a week, right there. So 1 to 2 right here, 2.5, I guess you want to say. Right here, if your goal is 100 pips, like mine's is per week, obviously not per day, you get another 1 to 5. Okay, so boom, you see 2 winning trades right there. Now, granted, all order blocks are, like I said in the beginning, all order blocks are not created equal. So let me find one that wasn't. Like, this is most recent. Okay, so you have this bearish order block, or I'm sorry, you have this last down candle before the bull run. So you would look at this as a bullish order block, right? This is how you would look at it as soon as you see it happen. So as you can see, this order block completely failed. And the reason why it failed was because, the reason why this failed is because you can see that they've already taken all of the buy side liquidity. So this shift in market structure showed us that they were willing to go down. Okay, once price had this shift in market structure, it broke down and it continued to break down. And you see that, okay, we had this sell side liquidity here, we had this sell side liquidity there. The chances of us continuing to go bullish was very slim. Okay, so you need to see, you have to see where the most logical liquidity rate is at, and you have to base it off of that. So that's just to show you in a nutshell, not all order blocks are created equally, but as you can also see, they are highly, highly probable when other market conditions are in place. You have that shift in market structure, you have, sell side or buy side liquidity to be taken or to be rated, and you should always do your top-down analysis to really get a firm grasp on where the overall order flow is. But that is how you enter and exit trades based off of order blocks. And so I hope you guys enjoyed this video tutorial. I hope it was very informative and valuable for you guys. If it was, definitely leave your comments below. Let me know what you thought of it. Let me know what you'd like to see more, from this channel. I'm live every day in the markets, Monday through Friday, so make sure to catch the live stream during the New York sessions. Also, if you guys haven't, please like and subscribe to the channel. Put your bell notifications on. Definitely helps grow the channel and get the algorithm, in our favor. So, yeah. So you guys, if you have any questions, feel free to drop a comment, and happy trading. Talk to you guys soon.